on revenue, which is our IFRS 15. Then part 1, we managed to introduce revenue standard, and we talked about how do you identify a contract. We talked about the 5-step model, and then we went on to part 2. And on part 2, we talked about how do you then separate each individual performance obligation, which is by using paragraph 22 as well as paragraph 27 to 29. So at this point, we are assuming that you have already identified a contract and you are able to identify the separate performance obligations. So we now want to jump to stage 3 of the 5-step model, which is basically determination of the transaction price. So how do you know the transaction price which you're supposed to be dealing with? So when you talk about the transaction price, the standard says there are certain factors that you need to consider when you're looking at the transaction price. And the first thing that you need to consider is your transaction price is the amount which you expect to receive, or the amount which you are entitled to in exchange for transferring those goods or services. So the transaction price, I think one thing that we're taking away here is your transaction price is not the total price. It's not the price which is put on the sticker. But it's basically how much money are you expecting to have in your pocket at the end of the day? How much money are you expecting to have in your bank account at the end of the day? So in other words, your transaction price is the amount which you will be given in exchange for what you have provided. Now let's give for a simple example. Let's say that you are selling a motor vehicle. You are a company that sells motor vehicle, and your motor vehicle is being sold for $25,000 US. But you're giving a cash discount on day 1. So if someone comes and buys in cash, they will not pay the full $25,000 US, but you give a cash discount of, let's say, $1,000, which means the person ends up buying the car for $24,000. So the transaction price, though the car is being sold for $25,000, you are not expecting to receive $25,000, you're expecting to receive $24,000. So your revenue becomes $24,000, the amount which you expect to receive. Now, revenue is affected, transaction prices are affected by also a number of things. The first one being sometimes that value or that price varies based on certain factors. So you've got variability of consideration, which affects your transaction price. We'll talk about variability in a few moments. Your transaction price is also affected by the timing of you providing the good or the service, as well as the payment which is being done. So sometimes, remember, a product can be prepaid. A customer can prepay for a product, which means the timing of payment and the timing of receiving the good or service may not be on the same day. And also sometimes customers buy on credit, which means they can get the goods earlier than the timing of the payment. So when you've got a significant timing difference between the timing of receiving the good or the service and the timing of the payment, then that can also trigger significant financing component. So you may have to consider if there is a finance charge or finance income which needs to be included. Then also sometimes you've got non-cash considerations where you are trading, but it is an exchange of goods. So an exchange of goods or services. So there is no money which is actually transferring. So you also need to watch out for that. How do you determine the transaction price if it's a non-cash consideration? Then lastly, we also have consideration to customers. So we're going to go one by one on these, but mainly focusing on the variable consideration and the significant financing component. And I'll ask you to go through non-cash consideration in the standard. So let's start with variable consideration. So your variable consideration is covered on paragraph 51 to 54 of your IFRS 15. And let's start by looking at what can cause the transaction price to vary. So some of the things which causes your transaction price to vary are discounts, for example. We talked about a cash discount in the example that I gave earlier on. So when there's a discount which has been given, which can be a cash discount or an early settlement discount, what it means is the amount which is now expected to be received is no longer the one which is on the take price. So that means there's now a variability in terms of your transaction price. Then sometimes you also have rebates which can be given. Remember, rebates are, if you meet certain conditions, then you can be given an adjustment to your transaction price. Now this usually happens when you go to wholesalers. So wholesalers usually give a volume rebate, which basically means if you buy a certain number of units, then the price changes from the tag price to a lower price. So for example, if you're buying units and you're buying 1 unit, the transaction price for 1 unit of cooking oil may be $7. But then if you are buying 24 cartons of cooking oil, each carton has got 8 in the box, which means now there is huge volume in terms of what you're buying. So the moment you buy a huge volume, the supplier can then give you a rebate, which means they'll give you a refund in terms of if you meet a certain volume, they're going to refund you this money. So in that case, that means the actual transaction price now depends on the volume at which you have reached. So rebates actually affect your transaction price. We also have refunds when you get to a shop and they say, after buying this product, you can actually come back and get a refund if the product is not working in the perfect condition, or you can actually come and claim a refund if you do not like the product within a certain space of time which will be given. So when you've got refunds which are being given, that can also result in variation in terms of the transaction price. We also have incentives, bonuses, penalties, and other similar items which also cause variability in transaction price. So each time you're going through this standard, when you get to stage 3, watch out for, is this price really fixed, or this price can change based on 1 or 2 things. If the price can potentially change, then that means there's an element of a variable consideration, which means paragraph 51 to paragraph 54 will then apply. Now let's say you've identified a variable consideration. What then do you do? So paragraph 56 and says the amount which you include is your transaction price should only include amounts to the extent of amounts which you do not expect to reverse in future. Which means if there's an element of you've got an amount which you expect to reverse in future, you received $10, but of that $10 you may end up refunding $3. That means you're reversing that $3 which you initially accounted for. So to the extent of anything that you expect to change in future, you're not supposed to include that in your transaction price. Which means, in other words, your transaction price should only include amounts which you think these are now definite sums. These are now definite figures which I'm going to have in my bank account. If you think this will be able to be reversed at any point in time, then do not include it in your revenue account as yet. But you can include it at the point at which you are now certain. So, in terms of your variable consideration, the standard then says an entity needs to estimate the amount of the consideration to which the entity will be entitled to in exchange for transferring the promised goods or the services. Which means at the point at which I've got variability, let's say I'm selling 10 units, and for those 10 units, the price is $10 each, which means I'm expecting to receive $100. But if I say to the customer, you can come for a refund if you do not like these units within 5 days, then I need to look back at the point of selling. Do I expect any refunds to take place? Otherwise, if there's a refund that I'm expecting to take place, that means there's going to be a reversal of that amount to the extent of the refund. So I should not include it as part of my revenue. So what I do is I make an estimate of the consideration of the amount which I do not expect to be refunded back. So of the 10 units, let's say I expect that only 7 units will not be refunded and 3 units will be refunded. That means my revenue will only be raised to the extent of 7 units at $10 each, which means my revenue becomes $70. And then the other $30, which I'm expecting to refund back, I need to account for it separately, not as revenue, but as a refund liability, which I have. So each time you've got variable consideration, you need to estimate the amount of the consideration which you think this will not be reversed. That is what you then recognize as your revenue. So let's talk about the methods of estimating. Since we said you need to estimate the consideration which you do not expect to reverse. So how do you estimate? What are the methods that we use for the estimation? So there are 2 methods which the standard talks about when you're estimating the consideration. which are, you can estimate your transaction price based on expected value. Now, expected value is basically where you're saying you've got a number of situations which can happen, and each situation has got a probability of happening. So what you do then is, for an expected value, you're now looking at what is the probability of each event. And if I take the probability of each event and then I consider every probability, I'll come to an expected value, which is kind of like the average of all the considerations which I have made. So expected value is one way. So let's say, for example, you have sold your product, again, 10 units. And of those 10 units, what is the probability that you will receive, you will not give any refund? Let's say the probability of not giving a refund is 10%. That means you've got 10% times the total value being the expected value of receiving the amount. Then what is the probability that people will come with a refund? Okay. Let's say that's 90%. So that means there's 90% chance that you will actually not be able to recognize this revenue. So which means 90% of that value is an amount which you expect to refund back. So in terms of that, that means the expected value becomes 10% of your sales. That becomes the amount which you recognize as your revenue. So expected value is basically an element of using probabilities. Let's say there are three possible probabilities in which you need to consider. So that means for each possible situation, you need to put a weight. You put a weight for each one, and then you multiply into that, and it gives you your expected value. The second method is the most likely amount. So most likely amount usually happens when you've got only two possibilities. That is, it's either it will happen or it will not happen. So most likely is which one is most likely to happen. That's the one that you then take. So for example, let's say that you have got a sale that you've made. And of that sale, you expect that there is a volume rebate that you need to give. And of that volume rebate, if you're using expected likely amount, you're saying what is the most likely value that what is the most likely situation that are here? Is it that people will reach this volume or people will not reach this volume? If it's likely that people will reach the volume, then you take the amount considering that the volumes have been met. That is, what is the transaction price that we have in the event of them meeting the volume? So that becomes your transaction price. If you believe that, I don't think that they are likely to reach that certain volume, then you use the other amount which excludes volume. So for example, if you're selling your product and saying if you reach 500 units, our revenue will be $50. But if you do not reach, our revenue is $60, which means $60 is the amount at which you sell for. But if your volume gets to 500, the price changes and goes down from 60 and comes down to 50. Now, when you look at which one then is my transaction price, between the 50 and the 60, you go back and look at, if we're using the most likely amount, then is it likely that you're going to reach 500? If it is likely that you're going to reach 500, then we're going to use the transaction price of 50. If it is not likely that you reach 500, then we're going to use the transaction price of 60. So it's basically looking at two situations, look at which one is the most likely to happen, and you pick the value related to the most likely to happen. Now, what if I've already received the amount? So there is a settlement discount, and I have received $100. But of these $100, if the customer, let's say it's a rebate, it's a volume rebate. Okay. So the customer has paid $100, but in the event that they reach the volume rebate, we need to refund them $10. So what do I do on day one? So what it means is, if I sold the product for $100, and if the customer meets the expected volume, let's say if per month they end up buying so much, or if they end up ordering so much, we'll then give you a refund, which means we'll look back at all the purchases that you've done in the for that month. If your total sales for that month get to a certain number, we'll then give you a refund for all the sales which you've done. Which means if we're selling at $100 for each of the orders which was being made, and at the end of the month, all the orders then accumulate to 500 units. What it then means is you have met the volume rebate, which means all these orders which we're selling at 100, we were not supposed to sell you at 100. We're supposed to sell you at $90 because you have then eventually met the volume rebate. So what then happens is, on day one, when you put the order and when you make your payment of $100, I need to analyze as to whether it's expected that you meet the rebate volume. If it is expected, then that means of that $100 that you've given, I should not recognize the $400 as revenue, because I know that at the end of the month you're going to reach 100 units. So I need to give you a refund of $10 for every order that you've made. So from day one when you make the order, what I'll do is I'll debit my bank with $100, I'll credit my bank with income revenue, which is only to the extent of $90, because I know that the other $10 I need to refund you. So I then raise the credit of $10 as a refund liability. At the end of the month, if you have not reached the volume which was expected, then it means that refund liability then translates into revenue. So then debit my refund liability and credit my revenue. If you do meet the volume rebate, that means I actually need to refund you. So I debit my refund liability and then I'll credit my bank to refund you back your money. So for variable considerations, I need you to also practice by going to the standard and you do illustrative examples which are given under IFRS 15. So I need you to do example number 20, example number 21, 22, 23, 24, 25. So you go to IFRS 15, illustrative examples, you take the IFRS handbook which is for illustrative examples, and you need to do from 20 to 25 and practice on variable considerations. But I also agree that sometimes your transaction price is affected actually by the timing between you receiving the good and you providing the good and the service and the money being paid. So paragraph 63 of IFRS 15 talks to what happens when you've got such a situation. So let's start with, if I provide you with a good today, or I provide you with a service today, but you do not pay today, you then pay 15 months from today. It puts us in a difficult situation. Because what it means is, if I've sold you a car today for $5,000, but you then pay me that $5,000 a year and a half from today, that money is not going to be worth the value of the car today. So there is time value of money which is in there. So the moment I've got a timing difference between the timing of providing the goods or the service and the receiving of the money, then I need to consider time value of money. So for example, I've sold the car today for $5,000. So I'll debit my receivable today with $5,000 because that's how much you owe me, and I'll credit my revenue for sale of the car, $5,000, because that is the value of the sale. But from today going forward, if you do not pay me the money today, as we go into the future and you still owe me, that money starts to reduce in value, it starts losing value. What I need to do is I need to charge you a finance interest for every month that you're holding my money until you pay me back that money. So what it means is, going forward, I've got a debit to my receivable, which further increases the value of my receivable, and my credit is no longer revenue in this case, but I'll then credit my finance income because you owe me money. So each time you're holding my money, I'm going to charge you an interest and then I put it as other income in my books. So the first thing that we're determining here is if there's a timing difference and the good or the service has been provided earlier, then it results in finance income. And the value of the revenue is the value of the good today when I provided it today. And how about if it's vice versa? A customer comes and prepays. So they give me money today, which means I debit my bank, and then I have got revenue received in advance since I have not yet provided the service. So I have revenue received in advance, which is sitting in my statement of financial position is a liability today. So I've received $5,000, but then I only provide the car, let's say a year from today. Now, when I provide the car a year from today, obviously the value of that car is not going to be equivalent to the amount that I've received today. But since I have the money, that customer who is prepaid, they're going to charge me finance charges every month that I'm holding their money, which means subsequent to today, my liability, my revenue received in advance, is going to increase each year by the finance charge. So I'll credit my revenue received in advance, and then I'll debit finance costs by the value of the interest component, month by month, month by month, which means by the time I get to 1 year, the revenue received in advance would have increased from the dollar amount that I actually received in my bank. It would have increased by the finance charges, and it's expected that it would have increased to the value of what the car will be at the point of selling it. Since on the point of selling it, the journal entry then becomes, you then debit your revenue received in advance, and then you credit your revenue on that particular day. So always your revenue account has to be equivalent to the dollar amount of the value of the product at point of sale. So it won't be based on the amount which was actually paid or the amount which was actually received by the entity. So let's play around with that significant financing component and try and look at it from both perspectives, where it's a prepayment as well as when it's an accrual. Now, whilst we're still on revenue, whilst we're still on significant financing component, it's important to note that the standard, however, gives a practical expedient, which is basically meaning you consider significant financing component, but the standard then says if the period, the timing between provision of the good or the service and the payment is less than 12 months, that is, the period between these two does not exceed 12 months, does not exceed 1 year, then in that case you do not consider significant financing component. So that's a practical expedient which is being given, which means they are allowing you to ignore significant financing component simply because it's within 12 months. So the first thing is, you first need to consider, do we have a timing difference? Even if it's 1 month or 2 months, do we have a timing difference? Yes, we've got a timing difference. This timing difference kicks in significant financing component. However, since the period is less than 12 months, we then apply the practical expedient, which allows us to ignore the significant financing component. So this is really very important, especially if it's a theory question where you actually need to explain the impact of the significant financing component. So for practice of this one, I need you to go and do illustrative example number 26 to 30. So variable considerations start at 20 to 25, and then significant financing component starts from 26 to 30. Yeah. So that's it covering transaction prices. So we're now going to move on to part 4 of this video class. And then in part 4, we're going to finish off on stage number 4 and stage number 5 of IFRS 15. Thank you.